Welcome to the Long-Term Investor. Today, I am joined by Gargi Chaudhuri, head of iShares investment strategy and markets coverage. She and her team primarily focus on delivering global macro thought leadership, investment insights, ETF implementation, and education. And she's got over 2 decades of experience. And I think a lot of why I was excited to have her today is that so much has been going on in the markets. And I want to make sure to timestamp this conversation, Gargi, because we're recording September 7th, 2022. I know, given how knowledgeable you are, by the time people are listening to this, I don't want anything to go stale. I want them to really respect what you're bringing to the table. So thank you so much for joining me here today.
Peter, thank you so much for having me.
Well, in 2022 has been a pretty challenging time for global investors. The S&P 500 was down more than 20%, which people refer to as a bear market. We've had a little bit of a relief rally, but ever since Jerome Powell, Fed Chairman Jerome Powell, spoke at Jackson Hole, we have seen a little bit more volatility. So can you unpack for us a little bit what's going on in the market, and are the lows in? What do you see coming in the near-term future?
Sure, Peter, happy to. So to your point, obviously a really volatile market. And in some ways, I would say that we've sort of had a regime change this year. When you think about everything that drives markets and everything that drives stock market performance, it's around your expectation of growth. It's around your expectation of inflation. And I'm sure we'll chat more about inflation because that's on top of everyone's minds. And many of those drivers of markets, both bond markets and stock markets, are actually a lot more volatile this year. And unfortunately, are probably going to continue to be a little bit more volatile in the future. So that's why we're calling it sort of a regime shift. So to your point, why has that happened? One big reason is that starting in the middle of 2021, we sort of started seeing inflation pick up. So that's the prices that we experience in goods, things that we can touch and feel, and services, things that we consume in the economy. And historically in the US, and actually for most of the developed markets, inflation has been very stable, around 2%. The central banks that you were referring to in the US, that's the Federal Reserve, targets inflation of around 2%. That's what the Congress has told them to do. And of course, what we saw this year was that inflation started moving significantly above that 2% target. And as a result of that, the Federal Reserve had to come and raise rates extremely aggressively. We haven't seen a rate rising cycle like this where they went from zero to what is soon going to be, 300 basis points, or even by the end of this year, 375 basis points in our estimate. We haven't seen a move like that for 40 years. So that certainly has had the equity market spooked, because the Fed is obviously making the cost of borrowing much more expensive than where it was in March of 2022. On the other hand, bonds are usually your safety. You have bonds in your portfolio to help you offset some of that risk from the stock market. Unfortunately, bonds haven't worked either, because the interest rates that obviously drive bond prices have started moving higher. So that's what's happened. It's all related to inflation. A lot of it is related to inflation. And that's what's driven the Fed. That's what's driven many other central banks, not just the Fed here in the US. That's what's driven stock prices. That's what's driven bond prices. Sadly, I still think there's a little bit more volatility ahead of us. I don't think this is quite the end. And, there are some concerns about a real slowdown in growth in the US. I don't think we're in a recession. We can talk much more about it, but certainly some pockets of slowing down that's already occurring in the US economy.
I think the interconnectedness of all of these different things is what makes this so interesting to talk about. I do want to talk about inflation at some point. I do want to talk about whether or not we're in a recession. But before I get there, I think I want to focus in on the Fed a little bit more. And they have recently come out to say, hey, rates are going to stay higher for longer. And the market has priced that in quickly. So how would you sort of characterize how you think people should be feeling about their bond allocations today, and any particular areas of emphasis that you might suggest?
Sure. So it's good that we're having this conversation today when interest rates have already moved significantly higher, when a lot of the pain that you have felt in your bond allocations has already occurred in your statements, because now we're getting to some levels where, because interest rates have moved so much already, because we have priced in those 375 basis points or so that I was talking about earlier, it's actually almost making fixed income attractive again. So the second part of that word, income, fixed income, you're actually getting some of that in your portfolio from bonds, which frankly you were not for the last decade when interest rates were zero or very close to zero. So if you just think about the fact that you can own something very high quality, something that is going to pay you back, something that is not going to default or go into bankruptcy. When you think about treasury bonds that are backed by the full faith in government, we think about US treasuries that are obviously very safe assets because they're backed by the US government. We think that getting sort of 3.5% in 2-year treasuries is tremendously exciting. And then if you just think about investment grade corporate credit, so looking at companies that are issuing debt, but these are really good companies that are not going to default, that are very highly rated, you can earn close to 5% in those, just looking at investment grade corporate credit. Thinking back to about 5 years ago, you'd have to earn, if you wanted to earn 5%, you'd have to get a lot of emerging markets. You'd have to go into high yield bank loans. You'd really have to lower the quality of your portfolio to earn that same 5%. So I think there's a huge amount of excitement. There's a huge amount of what I call yield of dreams in the fixed income markets today. And I think it's going to become a source of great income in your portfolios again, and a source finally of a little bit of what I call ballast. Eventually, when your equities go down, fixed income will prove to be that ballast, i.e. it'll provide you a little bit of upside protection in those down periods in the equity markets. That hasn't been the case, but I think we're nearing levels where that will be a ballast again.
Well, Gargi, I think you and I are on the same page there. And I do want listeners to pay special attention to the word investment grade corporates, because last time I looked, high yield bonds, the spread that they're earning still is below, I believe, their 10-year average spread. And the other thing is that investment grade corporates, the yield curve is positively sloped, whereas the treasury yield curve or the high yield curve has some points of inversion and some point in flatness. And all I'm really saying, again, for those who are less familiar with yield curves, is that you are getting paid to take on interest rate risk in the corporate bond space. And as Gargi is mentioning here, interest rates have already risen and prices have already changed to reflect that, where a lot of pain has happened. This might be the time that we can finally look at our fixed income portfolio and smile for once. It's been a while since people have opened their statements and smiled at that piece. I guess thinking about the downturn that we experienced in the first part of the year, and again, we've had a little bit of a rally here. We've had a little bit of selling, a little bit more volatility now that the summer's coming to a close. Is there anything about this downturn, in your opinion, that you think investors can learn from?
Sure. So a couple of things I would say when it comes to the downturn. Number one, volatility in the markets isn't new, right? We've all experienced them. This is something that is always going to be with us. But really our reaction to the volatility is what we can control. And I'd almost say that staying invested and not moving to cash entirely at the hardest times in the market is what I learned. Even if you look at just this June to August period, where you had a really rough going in the markets for the first 2 quarters. Markets was down, Peter, as you mentioned, in bear market territory. And then out of nowhere, you saw that immense bounce back in the markets from June 15th all the way up to till the Jackson Hole speech by Chair Powell a little bit before that. If you were not invested, you missed out on that. Now, going ahead, there could be more volatility, of course. You can make your portfolio more resilient by turning to sort of sectors of the market that do better in down periods, in downturns. But moving away from the market, I think, especially now when markets are down so much, is probably not a move that I would recommend. So that's one lesson that I am learning, and I have learned in the past, and I keep learning, and I hope that if you are new to the markets, you are learning that alongside us. I'd also say that cycles usually can be in multiple years. But this time around, because of COVID, because that was a restart. We shut down. All of us went home and watched TV and ate a lot and, ordered things on Amazon. And that's all we did for 18 months. And then we began to restart the economy again. So it's a new cycle, but it's a much shorter cycle, right? Because it's not exactly a cycle. It's a restarting economy. So expect things to happen much more quickly. So perhaps one of the things that I am learning this time around, and there's still more time to go, but I don't think that this will be a traditional credit cycle where you see cycles playing out in months and quarters. I think this will be more in months as opposed to quarters or even years. So we have to be a little bit nimble. Stay invested, but be nimble. When you're seeing signs in the market that the data is turning, or when you're hearing something interesting, put that on more quickly than not, because the cycle isn't as long this time around because it's a COVID restart.
It's interesting that you mentioned some of those data points. To me, it seems like because of COVID, because of the strangeness of shutting down the entire economy and reopening it suddenly and pouring a whole bunch of money on top of it, that there are some traditional indicators that are flashing contradicting signals about where we are. And so I've been telling people to be cautious about putting too much emphasis on any given one indicator or rule of thumb. I'm just kind of curious, though, in your opinion, we have not reached the point at which most people would say we are in a technical recession. But what do you feel about where we are, recession or not, in terms of also where we're going, not just now, but where the economy is headed?
Love this question, Peter, because my team and I spend a lot of time building out our own recession dashboard, if you will. Because to your point, there's so many contradicting signals out there, and what might have worked in a previous cycle might not necessarily hold the same signal value this time around. What we learned recently at the end of July was that there were 2 negative quarters of GDP growth in the US. And technically, that can be called a recession. But actually, when you think about what a recession really means, and by the way, if you Google recession and you do the Google charts, the number of times recession has been searched has gone up tremendously. So people are thinking about this question a lot. So I'm glad we're discussing it. A recession is a broad-based slowdown in the economy. It isn't just that technical definition of 2 quarters of negative GDP. Now, what we're looking at in our recession monitor is several sectors of the economy. So we're looking at the labor market, which of course is very important. How are people feeling about jobs? Are jobs being created by companies or are they not? And obviously, we all know this because we follow the news, that jobs are very much being created. There's 11.2 million open jobs right now, and the unemployment rate is not at its all-time lows, but very near to it, about 3.7%, which is extremely low. So that's a good signal. That's a very positive signal and not a recessionary signal at all. Wages are still going up. People are still moving jobs and therefore are able to capture higher wages. Again, something that's another positive signal. The consumer is still spending. Personal income, personal spending, those are still very positive data. And obviously the consumer in the US is a very big chunk of the economy. Now that's all good. When I look at the other side, though, on the not so good side, what we're noticing is there is a slowdown in manufacturing and industrial production. And that, of course, is worrisome to us because it's signaling a slowdown near recessionary levels. We're also looking at credit creation in the economy and seeing how much credit is growing. And there's several ways to do that. And we're looking at that credit creation. And there's a little bit of slowdown there, which is a little bit concerning to us. So when we look at the entire economy, there are certainly some flashing red signals, but not all. So I'm not willing to call this a recession yet. However, I do think that it is possible if the Fed keeps raising interest rates, and perhaps if they even go higher than what is priced in by the market now, which is not my base case, but if they have to, for whatever reason, go to 4 or 5%, I think unfortunately that could lead us into a recession. I will say the European story is completely different. They are most certainly going into a recession because there is that natural gas energy price shock that's coming their way, and we fortunately do not have that. But as of right now, not seeing a recession in the US, but certainly can see one in 2023 if certain conditions change.
Now, if you are not seeing a recession, then I might know the answer to this next question as I want to dig into inflation a little bit. Because the Fed is raising interest rates largely in response to these higher prices. And the Fed has communicated sort of what they plan to do the rest of the year, to your point. And for them to do more, I suppose inflation would have to surprise to the upside. So, I mean, given you actually have experience as an inflation trader and a portfolio manager. So I'd be curious to get your opinion on inflation in general, whether it's peaking, whether or not it's sticky. And again, for those listening, this is September 7th. So we will have just gotten another CPI print by the time you're actually listening to this episode.
Right. So we're going to put on some predicting hats. And I'm going to say that if you're listening to us on September 15th, by now you've seen that the inflation print that just came out 2 days ago has shown that inflation still remains very sticky at approximately 6% on core inflation. Now, core inflation means looking at those components of inflation that subtract the impacts of food and energy prices. And why? That's because food and energy prices tend to be really volatile because they're, not as controllable by monetary policy. That's why the Fed likes to look at the headline inflation, which is the top line number, which currently is running at 8.5% as of today. But by the time you're listening to this, it's probably moved down lower. It's probably below 8% as the report would have shown. And core inflation is still sticky. A couple of things to remember here. If we look at now to the end of next year, so not the end of this year, but the end of next year, inflation will still remain above the pre-pandemic levels that we saw. So the pre-pandemic levels for 2 decades before the pandemic, till 2000 to 2020, inflation averaged about 1.8%. That was wonderful. We never had to think about inflation and all was well with the world. Now, if we look ahead, inflation is actually not, unfortunately, going to go back to those pre-pandemic levels of below 2%. I think we're going to see inflation probably close this year at maybe 5.5% is our prediction, and then closer to 3% by the end of 2023. So still lower than today's levels, but significantly higher than, number one, than what the market price is in, but number two, the pre-pandemic levels. So recognizing that inflation is going to be a little bit stickier for a longer period of time is really important. And the second thing that I'll point out that's really fun, or at least for me it's fun, is where this inflation is coming from. So we talked about COVID, and right after COVID, there was what I like to call disruption inflation. Right? So we all sat at home and we ordered things because we couldn't go out and consume things. So the part of inflation that moved up significantly was called goods inflation. So again, things that you buy, that you order on Amazon. The part of inflation that did not go up was what's called services inflation. That includes things like what you're paying on rent. That includes things like what you're paying on airfares to go on vacation or hotel rooms. All of that did not go up for obvious reasons. We were home. Now, what we're going to see happen over the next, we've already seen this, but we're going to continue to see that in a more meaningful manner, is that the goods inflation that's upwards of 10%, or today it's going to be lower by the time you're listening to me, is going to continue to move lower. And the services inflation, which is where we go out and spend in the economy on things that we love doing, like traveling and just entertainment, sports, theater, movies, things like that, that's going to continue to remain a bit sticky. So there's this pent-up demand for vacationing, for travel, and that's still going to come through in the data. So I think that's fun, and you're going to find that persist for some time, at least till the end of this year.
Well, people seem to notice energy prices and food prices most frequently. And again, I think people will give you the good grace of the fact that we don't know what the next print is. But can you talk just a little bit about the trend that leading up to at least the point of this recording has been happening with the energy and food prices?
Yeah, sure. So a big disruption in the food market and the energy market was, of course, the war. Russia and Ukraine, as we all know, Ukraine and Russia combined is considered the breadbasket of the world. And of course, Russia provided a huge amount of energy as well to Europe. And that has impacted or had impacted energy and food prices in a pretty significant manner. Now, we have seen energy prices come back from the highs that we had seen earlier this summer and spring, which is good news, but we're certainly not going back to sort of a $60, $70 price level, because there are those disruptions that are going to stay in place for some time. So, we've obviously heard about Nord Stream 1 getting shut off completely and what that might mean for energy supply for the rest of the world. This is a global market. Just because it's related to Europe and Russia doesn't mean that oil prices here will not be impacted. These are all global markets, so there will be that interconnectivity. So what we have seen is, of course, energy prices picking up pretty significantly and then coming down. Now, what that means, though, for you as an investor and a listener is, thinking about longer term impacts of supply shifts, supply shortages, supply chains that have moved. And this is where, food, I think, is particularly interesting, where obviously we've all experienced our own food inflation if you go to the grocery store and what you pay for things like bread and eggs. And what we're focusing a lot on is agricultural producers. So investing in companies that are actually looking at the future of food and trying to enhance crop yield, trying to get more out of, using technology to enhance crop yield and get more out of the same input. So looking at those companies using what we call thematic ETFs to look at those companies that provide you for future of food. And similarly, within the energy space, definitely investing in traditional sources of energy, because some of these energy companies obviously are going to have much elevated cash flows for some time, and their earnings will show that. But then also thinking about clean energy in your portfolio. If this has shown us anything, it just has shown me at least, and I hope many of you, that we have to navigate to a world where we're not just reliant on a single source of energy.
Now, a lot of our conversation to this point has been a bit US centric, which is my own doing, but I do want to talk a little bit about international and emerging markets. They, in the equity side, have trailed US markets really since the financial crisis, since coming out of the financial crisis. I'd be curious to hear what your outlook for these equity markets are, given the current environment and in the longer term.
Sure. So we'll talk about emerging markets with the view that one of the big drivers of emerging markets has obviously been the fact that interest rates have been rising, and real interest rates have been rising so significantly. And what we haven't spoken about yet at all is the strength of the US dollar. Now, when you think about emerging market countries, much of their debt is priced in dollars. So if the strength of the dollar continues and is, the dollar is very, very strong, their debt that they have to pay back is moving up significantly, which is a burden on EM countries. Having said that, there are pockets of opportunities in EM, specifically EM emerging market bonds, but certainly emerging market equities as well. And where might those be? So I'd say, number one, thinking about an idea that we spoke about earlier around shifting supply chains. We've heard Janet Yellen talk about a concept called friendshoring, the idea that we've seen so much supply chain disruption, that we all know about supply chain disruption now. It's a part of our daily lives. We read about it in the news. This idea that companies are no longer going to focus just on the cheapest place where they can get goods from, but actually on the most resilient place. So a supply chain resiliency is going to be a focus. And then thinking about countries that might benefit from that. So therefore the friendshoring concept. And I think there are a couple of emerging markets that come to mind, especially the ones closer to home. So think of LATAM as a huge beneficiary of that. So thinking about Mexico actually as a beneficiary of that, obviously an EM country, and that could, both from the equity side and debt side, be a big beneficiary of the friendshoring phenomenon that has already started and will continue to do so. I'll also say that, the dollar has obviously risen significantly this year. That probably continues to rise for some more time. But I think there's going to be a peak dollar, and I don't think we're 4 years away from that. I think we're about 4 months away from that. I think when we finally see the peak, when the Fed is actually done with their hiking cycle, which I hope is going to be the end of this year or by March or so of next year, I think the dollar might stabilize a little bit. And I think when that happens, that'll be a really good time to go back into emerging market, especially on the bond side, where you are earning about 8.5% or so. So it's really attractive. And on the equity side, like I said, benefiting from that theme of friendshoring could be a really good opportunity.
I love the friendshoring point. I'm glad that you brought it up. And I think for a lot of investors who have been frustrated with their international or emerging market exposure, BlackRock actually has a brilliant little table talking about how everyone hates being diversified. There's never a time where it feels right because you always own the loser. And I know it doesn't feel like I'm that far removed from the years when I used to have to convince clients who are saying, why do we have so much US? We should have more emerging markets, after the decade of the noughts. Here, emerging markets barely get any sort of airtime among client conversations, but international, because it's trailed for so long, there was a long period where people were questioning that diversification. However, there's another piece from BlackRock that I'll be sure to link to in the show notes at thelongterminvestor.com that shows the MSCI World Index when you're looking at rolling 10-year periods compared to U.S. markets. When U.S. market returns are below 6%, international markets outperform 94% of the time, I believe. And when U.S. returns are below 4%, international markets outperform 100% of the time historically. So with that in mind, Gargi, I guess we've kind of talked a little bit about outlooks for emerging markets. We've certainly talked about recession versus not recession in the U.S. Do you have any sort of view on U.S. equity market outlook?
Yeah, so listen, it depends. When you talk about outlook, it depends on your time frame. So I think if you're still thinking about the next 6 months, unfortunately, I do think we can see a little bit more volatility and we can see some lower prices here. But again, what I had said maybe 20 minutes ago around staying invested, but just tilting your portfolio to areas that can offer you a little bit more resiliency in your portfolio. We like healthcare. We think minimum volatility strategies make a lot of sense in your portfolio because they tend to outperform in a downturn. But I'd also say that, look, mostly investors aren't investing for the next 6 months. They're investing for the next 15 to 25 years or even longer. Stay invested. Equities are a really good or perhaps one of the best inflation hedges. So even though we might see some turbulence ahead for the US equity markets over the next few months, and even if we do go into a recession, it will probably not be a GFC type recession. It will probably not be a balance sheet recession. It is most likely to be a Fed-led recession. And that's why I think staying invested should remain your North Star.
Well, I appreciate you bringing up that point again, Gargi, on the long-term nature of investing, because while what we're talking about to me is fascinating and I think is actually important, if you're an investor who is saving for something that's many years out, if you're a retiree, you're funding a full retirement of lifestyle expenses. If you're working, you have decades until you need to tap your portfolio. I think if you let some of these macro issues shrink your mental time horizon to a point where it really doesn't match your financial planning horizon, that's when you're going to be susceptible to making mistakes. I do think, however, it is important for people like myself and you, Gargi, to have our finger on the pulse of this to make sure that we are helping those that we serve make good decisions with their money. I cannot tell you how appreciative I am of you being here today to help us do that. So thank you so much again for your time.
Thank you for having me.
And for all of you watching us on YouTube, please subscribe, like, comment. That helps people find the channel. Same goes for those listening on your favorite podcast platform. I love when people not just rate the podcast, but leave a written review, because that gives me a little bit more sense of what it is you all want to hear. So again, thank you all for doing that. And until next time, to long-term investing.